We're talking house hacking again today. This time we're talking about buying 2 to 4 unit properties using a Fannie Mae conventional loan. Now, why would you buy owner occupied units? And that's what we're talking about today. When you talk about house hacking, you're talking about buying a house, renting out portions of the house to help make your mortgage payment. Now, there's no better way to do this than a 2 to 4 unit property. You can buy, sure, you can buy a single family property and you can rent out bedrooms in the house, but now you've got roommates, and that's not fun. That's not the same as being a homeowner. When you buy a 2 to 4 unit property, it allows you to buy a home to live in and then rent out the other units for additional income so that they're paying you and they're helping you make your mortgage payment. And this is a super powerful strategy, especially when you're in a market where interest rates are a little bit higher. Because if you're living in one unit and somebody's living in the other unit and paying half the mortgage, well, interest rates are about half what you really are paying, aren't they? Your payment is half of what your actual mortgage payment is. So it's a little bit of gray math there, but it 100% works and it is absolutely true. So the reason I'm breaking this down by agency. So last week we did, or earlier in this week, actually, we did the FHA guidelines. Now, FHA, I will tell you, are the most flexible guidelines for buying 2 to 4 unit properties. So don't be scared by the qualifying requirements on a conventional mortgage, or actually the down payment requirement is what's going to give you the sticker shock. So the reason I'm doing this series is because there are all these differences between every single program. So we're going to talk about the loan program types that are available with Fannie Mae. And these are the same points we're touching on all of this video series for every different agency. So the loan program types, the loan to value or the down payment you have to put down, what your credit score, the minimum credit score requirement, non-occupant co-borrowers. So this is somebody who goes on the loan application, right? So they're putting their information on the loan application, their income, their assets, their credit score, but they're not going to live in the house. So we're going to talk about that, whether that's allowed or not. And then we're going to talk about reserve requirements. Reserve requirements is how much money you have to have left in the bank after you buy the house, right? How many months, and it's measured in months of payments. How many months of payments do you need to have in your bank? Then we're going to talk about accessory dwelling units. So an ADU, or an accessory dwelling unit, is a great house hacking strategy, but what it usually is it's a detached unit that's separate from the other property. So a duplex, you live in one side, you share a wall, and then the other family lives in the other side. That's a duplex. Triplex, the same thing. Each family is probably sharing 1 or 2 walls with another family. An ADU would be like a 600 square foot tiny home in the back of the property that qualifies as a living unit based on underwriting guidelines and appraiser requirements. So some programs allow it, some programs don't. But if you can get a duplex with an ADU and you can use one of these programs, you are absolutely cranking with cash flow. And then we're going to talk about if you can use the rents. We know we can use the rents as income, right? You know that when they write you a check, you're going to put that check in your bank, and then the check you write to the mortgage company has been offset or subsidized by the renters. But can you use the rents to help you qualify for the loan? And we're going to talk about that. So let's go. So the Fannie Mae loan program types that you can use a fixed rate mortgage. You can use an adjustable rate mortgage that's fixed for 5 or more years. So usually when you see adjustable rate mortgages, you see 3-1, 5-1, 7-1, and 10-1. Those are typically your ARM mortgages, your adjustable rate mortgages. Now, what this means is that the first number is how many years that the mortgage is fixed, right? It's at a fixed interest rate for X number of years. 3-1 ARM means that it's fixed for 3 years and then it adjusts once a year. 5-year ARM means it's fixed for the first 5 years and then it adjusts one every year after that. And so, in order, if you're going to buy units, 2 to 4 units, and you want to use an adjustable rate mortgage because sometimes the interest rates are a little bit lower, but you're taking that risk on the back end, right? You're gambling that the market will be better in 5 years and that your interest rate won't go up after 5 years. You can use it for an owner occupied property, so you can live in it. You can use it on a home ready program. So, home ready is the affordable housing program by Fannie Mae. So there's Home Ready with Fannie Mae and it's Home Possible with Freddie Mac. And these are special programs. They have reduced costs. They have reduced restrictions on them. And you have to meet certain low to moderate income guidelines, requirements in order to qualify for this loan program. And we don't dive into this program here, but if you're doing your research and you're looking at a home ready program, you can buy a 2 to 4 unit property. And you can buy a 2 to 4 unit property using a Fannie Mae conventional loan to buy an investment property that you don't live in. But that's not what we're going to talk about today. We're not talking about investment properties necessarily. We're talking about owner occupied properties that your renters are going to help you pay your mortgage payment. Maximum loan to value. So on standard and home ready, so the affordable housing, the affordable mortgage, the affordable housing product, or the mortgage, or the standard conventional Fannie Mae loan, a 2-unit property, the maximum you can go is 85% loan to value. So the loan cannot exceed 85% of the value or the purchase price of the home, whichever one is. Well, actually, it's a purchase price with your when you're purchasing the property. So it's purchase price. It's not the appraised value. It is the purchase price. If you're buying 3 to 4 units, it's 25% loan to value. Now, the minimum contribution is 5%. If you're putting less than 20% down, at least 5% of the down payment has to come from your own sourced and seasoned funds. 100% of the down payment cannot be a gift from an acceptable gift source. And I did a whole series of videos for every agency on this channel about what the down payment or what gift funds and gift of equity requirements are. So you might want to look at that. If you're planning on getting a gift from somebody, you need at least 5% of your own funds. So how does that translate? How does that translate into a down payment? What's the down payment requirement? So we know what the loan to value is. It's also a down payment. So standard and home ready, 15% down for 2 units, 25% down for 3 and 4 units. And again, if you're putting less than 20% down, you have to have 5% of your own funds to buy a 2 to 4 unit property using a Fannie Mae loan. So the minimum credit score is generally, it has to be approved by the automated underwriting system. But generally the minimum credit score for conventional is 620. But I'll be honest with you, if you're trying to buy a multiple unit property, it's pretty hard to get approved at a 620 credit score. Fannie Mae, at least more recently, has become much more strict, and it's not giving approvals for credit scores. There has to be a lot of compensating factors to get an approval on a credit score under 680, probably. So if you have less than a 680, and you're trying to put the minimum down payment down and you don't have any reserves, you're probably going to have challenges. But in that case, that's why I'm doing this series of loans. If that was the case, and you couldn't get an AUS approval for conventional, I would look at FHA. FHA is going to probably cover that gap, and you're probably going to be allowed to qualify using more flexible guidelines like what's available in FHA. So non-occupant co-borrower, which is a co-borrower that's not living in the home. Now, this doesn't have anything to do with the down payment or closing cost gifts. If you're getting gift from somebody for down payment or closing costs, that's different from a non-occupying co-borrower. A co-borrower is somebody who's on the loan application. They're giving their social security number. They're putting their income, their assets, all of their reserves that is contributing to helping you buy the house or buy the units, but they're not going to live in one of the units. So this is allowed on with standard and home ready. So non-occupying home buyers is allowed standard and home ready loan programs. Reserve requirements. So the automated underwriting system will determine reserve requirements based on the risk assessment of the loan. Now, I will tell you, most conventional loans are going to have reserve requirements. With FHA, there are no reserve requirements for a 2-unit property. But there are reserve requirements if you're buying a 3 or a 4-unit property. There are going to be reserve requirements almost always with conventional. But again, the automated underwriting system, you're going to put in all your information. It's going to do a risk assessment, and it's going to say, this is too high of a risk. We need to offset this risk by making sure you have enough money in the bank. Because again, remember, you're kind of going to be a landlord if you're going to do this house hacking strategy. So that means you have to know, you're going to learn how to manage tenants, and they don't always pay. They don't always pay on time. And if you have to evict them, or maybe you don't have to evict them, but at the end of the lease, they trash the unit and it's going to take you 3 months to repair it before you can rent it out again. These are all the factors that the automated underwriting system is considering when determining how much of a pad you should have in the bank account just in case of an emergency. Now, additional dwelling units. So additional dwelling units are not allowed with Fannie Mae. If you're buying a 2 to 4 unit property and there's a detached unit, that's not going to be allowed under the Fannie Mae guidelines. However, Freddie Mac is going to allow it up to 3 units. The Freddie Mac guidelines are another video that I'm doing because there are a lot of similarities. I'd say there's 95% similarities between Fannie Mae and Freddie Mac Conventional, but it's those nuances that are not the same that's important to know. Because if you don't qualify for one, the other might qualify. For instance, if you have an additional dwelling unit. Yes, you can use a percentage of the rents to qualify from the non-occupied units. Typically, that calculation is 75% of the projected rents from the unit that you're not going to live in. Now, there's a couple of different ways that that number is calculated. So if you're buying a property from an investor who's selling the property and they're already somebody in the other unit, not the one that you're going to occupy, but if there's already a family in the non-occupied unit, and they have a lease that's like a year-long lease or something like that, you have to accept that lease. You have to continue to allow that family to live in that unit under that lease. In that case, that rent is their rent is fixed based on the terms of that lease. If there's a tenant in the property, you have to use the lease amount. Now, if there isn't a tenant in that property, you're going to use what's called a fair market lease. Fair market lease. I'm losing my mind right now. Fair market lease assessment. So market lease assessment. I don't know what it is, or it's a rental assessment. Basically, okay, no, we're keeping this in here. This is staying in here because, yeah, so no, this isn't. Now, if you don't have a tenant in the other side and it's vacant, then what you're going to do is the appraiser is going to find out what a fair market value assessment is for the lease income from that unit. So if you're already kind of doing the math, if the unit is vacant, you're going to get fair market rent values. So it's probably higher than when the family signed the lease back in the past, depending on how long they've been in the home, depending on what the other landlord, how long they've lived in the property, what the other landlord was teaching, what was charging them. So there is an advantage if the unit is not occupied, especially in this market, because interest rates are a little bit higher. So there's not a lot of competition for buying homes, but there is a lot of competition for renting homes. And when you have high demand for rents, then rent prices go up. So if you're owning this property or this rental property, you're the one that gets to take advantage of that. So again, if there are tenants in the units that you're not going to live in, you have to honor what they're paying, and you're going to be able to use 75% of what they're already paying. If not, you're going to get a market value assessment or rental survey from the appraiser. They're going to determine what people are paying to rent a unit with those amenities, with the size, bedrooms, bath, all that kind of thing. So as you can see, there's some complexities here. There's a lot of wiggle room. There are a lot of different guidelines. These guidelines are different. These Fannie Mae conventional guidelines are different from Freddie Mac conventional guidelines. They're different from FHA guidelines. If you're a veteran, they're different from VA guidelines. And if you're buying using a rural development loan, USDA loan, it's different from them. So it's important that you work with an expert. If you found this video because you're like most people, you went online, you were looking for information, and you thought you could push a button and get a mortgage, and all you got was a kid in a call center that's been in the mortgage industry for 6 months, they're not going to know these nuances. They're not going to know the guidelines. They're just inputting it into a computer, and they're probably not even inputting it accurately because they don't have enough experience. So hopefully you found this, you have found a community of experts. So when you're working with an experienced mortgage professional, they're going to reference the guidelines, they're going to explore all of your options, and they're going to present you with your options. Maybe you don't qualify for that Fannie Mae loan, but if we switch it to FHA, if we switch it to FHA, you're going to qualify because of your credit score. Or if you switch it to Freddie Mac, you're going to qualify because there was an ADU on the property, right? So it's important that you work with an experienced professional. And that's why we built findmywayhome.com. I built findmywayhome.com over 15 years ago in 2007, depending on when you're watching this. So what we do there is I can connect you with mortgage professionals from around the country that are experienced mortgage professionals. They understand the guidelines, and they don't like to take no for an answer. They're going to do the work. They're going to fight hard for you, and they're going to give you your realistic options. They're not just going to say yes because they think that's what you want to hear, and then the underwriter tells you no later. They're going to make sure that they help you up front so that there's easy sailing and no surprises in the future. So if you go to findmywayhome.com, you're going to see the link down in the description below if you're watching this on YouTube. Or if you're watching this, if you're watching this on YouTube or anywhere else, I guess, go to findmywayhome.com. Now, you can either find an expert near you, which will show up on the page. It'll show you people who are licensed in your state, or you can go to the state directory and you can click. You can watch their videos. You can read their content. You can get to know, like, and trust them before you reach out to them. Or if you would like, you can just fill out the form and I will connect. The form is just let me know what your questions are about qualifying for a mortgage. That's it. Tell me where you're living, and we're going to connect you with an expert that best fits your needs and your situation. So if you're watching this and you're exploring a little house hacking strategy here, buying 2 to 4 unit properties, becoming your own landlord and getting other people to pay your rent, I want to give you a huge congratulations. This is a super smart strategy, and you're going to do very, very well in the future with this strategy. So congratulations for being in the market right now. And I hope this was helpful, and we will see you next time.